Dear subscribers, as you know, we shared many information for you, and we are studying very hard to find current news for you. However, I cannot use this channel for future. Please follow our new channel called as Daily News Report and watch our video to support us. Link in description. Also, you can reach the video we shared on Daily News Report by clicking on the top right button. We highly recommend watching, subscribing, and sharing. We will continue to share some news on this channel, but we take precautions against some situations for future. Thank you for supporting us.
Either side in all this political fight. To me, I look at it a bigger view, which is that the system is broken, and we're going through a fourth turning. And I actually think the underlying problem is it's not really the people in that political office, although to a degree that's a big problem. All the politics are corrupt, but the bigger problem, and I thought it was very funny on Twitter, a guy named Rudy Havenstein, who's a fabulous commentator on Twitter, said, "Hey folks, the Eccles building, the Mariner Eccles building is only 2 miles down the mall. You might want to consider going down there." And of course, that's the head of the Federal Reserve, or where the Federal Reserve headquarters are. So it's, to me, the problem, the fundamental underlying problem here is unsound money, and it's been building up for years, and it's now manifesting itself. And obviously, this is a trend in a direction that one could argue is very bad. Bad for the establishment, bad for the broken system. One could also argue, as I do, that it's very good in the sense that the system needs to fail. It needs to be broken. It needs to be cleaned out. We need to get back to sound money. I've been saying that for some time, obviously sounding like a broken record. And frankly, it's a little humbling to me because I'm the broken clock that's now about to be right, once a day. I mean, I've been singing this for 10 years and everyone thinks I'm nuts. And now when we see what's going on in all these financial markets, it's beginning to look like maybe I wasn't so nuts. And maybe for that one brief moment, I'm about to be right. The UBI question and what does it mean in terms of spending? Yeah. So look, we've got a very unhappy country. We did some crazy shit with this lockdown, which has destroyed, the economy and commerce over, which probably nothing worse than a bad version of the flu. And, people are universally hurting economically. And, in 2008, we did socialism for the rich by bailing out the banks. And it's completely and totally understandable that the average American would say to themselves, okay, government, you did it for them. What are you going to do for me? This is, beyond my control, and I'm hurting badly. And obviously therein was the fight over the 600 or 2,000. Of course, they didn't get either one done. But, why doesn't the 2,000 become 4 or 5 or 10 or, some bigger number? Of course, Larry Summers asked that, and that indicates to me that, the other side knows how at risk they are here of hyperinflation. If they go completely direct and start printing money. I think there's very little doubt that we will go towards some kind of a UBI. We have to. If we don't, the economy collapses. I mean, there will be those who will say, hey, doing this is going to be inflationary and we're going to destroy the dollar if we do it. And the alternative is going to be, fine, are you going to let the whole thing, collapse into a heap with everyone going bankrupt, getting thrown out of their houses and a depression that's worse than the 30s? And I think of those two bad choices, they're going to choose the print money choice. I mean, and say, be damned with inflation, we'll deal with that later. And this is what, Weimar Germany did, and Havenstein, at the time, he kept thinking, well, we'll figure out a way to solve it. But of course, there really is no solving it until the currency is worthless. So in my opinion, there's some big signposts that we see recently that I saw picked up on. They're going to be talked about in my letter. Stephanie Kelton, who's the woman from State University, Stony Brook, New York, tweeted that she thinks that we could spend $5 trillion in stimulus next year to get this economy on its feet and going the right way. And she's a big advisor to Biden, and Biden has very much said he wants to be an FDR-like president, save the economy, get things going again. And, Lord knows, I mean, we do need infrastructure in this country. There are intelligent things we could actually spend money on, even if it was printed money. And, $5 trillion is a big number. Before this all happened, 2019, the deficit was $1 trillion. Last year was 3.1, year ended September. I mean, we're running at 2.6 this year. So add 5, what does that make the deficit this year? $7.6 trillion. I mean, we only collect $3 trillion of tax income. Biden's program says they're going to take it up by another 300 billion a year. So, okay, fine, 3.3 or 3.6 in tax income. But the point is, and that money, everyone thinks it grows on trees. I mean, So the most interesting thing, I talk about this again in a letter I'm about to publish, that, Gary Cohn, who's an ex-Goldman Sachs partner, made a couple $100 million there, like all those guys do. They're criminals. He basically also served on Trump's economic committee. And, he said, yeah, I agree with Professor Kelton's comments. I mean, the numbers sound about right. And we all know it's not going to be an issue because the deficits really haven't been a problem in terms of inflation. And so what we've got is kind of a collective mindset that inflation's not a problem until it is. And, just because we've had 40 years of deflation, there's a lot of, human beings kind of get conditioned. If something happens over and over and over again, you kind of think to yourself, well, that's always what's going to happen. And so we've got 40 years of deflation, relative deflation, falling interest rates. And I think there's a collective belief amongst many investors and many people in Washington, D.C. I mean, it started, remember Cheney said, Reagan proved deficits don't matter. And here we had Gary Cohn recently saying that, the deficit shouldn't be an issue. And, they've, as Luke Roman, who's a brilliant macroeconomist, pointed out, they've said that they're going to actually hold the rate of interest well below GDP growth, no matter what it takes. It might even imply negative interest rates, but that's a construct that's going to create a deeply negative real rate, very similar to what they did post World War II. And deeply negative real rate, by definition, means that anyone who's holding a fixed income security is losing money because the inflation is eating them up. And so we don't have inflation yet, although we do, because the statistics are misstated, but we don't have statistical inflation yet, but we will. And I think it's going to blow people's minds how quickly it's going to come and how bad it's going to get. And we're starting to see signs of it, right? I mean, so, Bitcoin is a sign of it. Tesla up 700% last year. There's another sign. Gold coin purchases in the last year were up 700%, at the U.S. Treasury. I mean, these are things that Austrian economists like myself would say are signs of a crack-up boom. That people, once you realize, the issue here is a psychological issue, Tom. Once you realize that the currency that you hold is continually losing value, you say to yourself, okay, savings makes no sense. Bonds makes no sense. In fact, I should take out a mortgage and buy another house, or I should buy a car on time, or, I've got to invest in sound forms of money. It's Gresham's law, which is expressed by a Brit, from the 1500s. It basically said, sound money bad money drives out good. And what that means is that basically people save in something they know is not losing value, or is likely to increase in value in the future. And they spend as quickly as they possibly can the money which is losing value quickly. And in this case, I think all money that's paper and that's printed is losing value quickly, and that accelerated. And so everybody kind of, I know that in the gold mining space, a lot of people thought, well, gosh, we went awfully quickly up to 2000. And, I've got a lot of people saying, well, we got a model 1700 going forward. I'm like, guys, no, you're not looking at this right at all. I mean, this is going to break free. Like in the 70s, we're going to get our jailbreak out of, we just broke out of the 1900 high, which was established in 2011. And, when we really get through that with authority, we came back, tested it, went through it. We're now, dicking around right on the line, downtrend line. And once it really gets going, we're going to 2,500, then we're going to 3,000, then we're going to 3,500. And, I manage a fund that invests in gold mining stocks. I mean, these stocks are cheap at 1,900. So, and their operating costs don't change as quickly as the price of gold could change. And so the operating leverage in these things is just stunning. I mean, I expect, I have a portfolio. I've been up large the last 2 years. I expect next year is going to be another year probably better than the last two. So, it's a hell of a mess. And it's quite sad because there are going to be a lot of people who are going to be hurt by it. But, I didn't invent the monetary system. And, it's you sit down to, you do things wrong, and eventually there's a banquet of consequences. And that's what we're seeing here. I mean, it's been a long time coming. We went off the gold standard in 71, in 2008. I thought at that point in time, and I was deadly wrong in 2008. I thought that was the beginning of the end of fiat currency, and that, we're going to have massive inflation because of all the QE that came. And, I was wrong. I mean, I was completely wrong. It cost me and my investors a great deal of money. I was right for a few years. Gold went up a lot in 9 and 10. And then they figured out a lot of ways to bring it back down. And the cycle turned.
So, Larry, what are some of the differences between now and 2008? If you'd like to highlight
It's a great question. The biggest one is that we're going direct now. We're actually 2008. The money that was created was injected into the banks, remained on bank balance sheets, and unless banks created credit, it didn't lead to an inflationary outcome. There was no transmission mechanism to the people, and credit is what's needed to actually create the working money supply. And so there was more money created, but the velocity of money fell. So that's item number one. Item number two, and it's a big one, is that at that point in time we had foreign buyers for our bonds, and we were and a positive real interest rate. Not greatly so, but still positive. And so foreigners could, buy the dollar, buy our bonds, hedge out the risk, and that all worked. That ended in Q4 of 2014. And it's not surprising that soon after that, the price of gold bottomed and we started going the other way. I mean, now we really are having a very hard time selling our bonds. The stories are told that the long end of the U.S. bond market is very poorly bid. And so the Treasury has moved a lot of the money that they've been raising into the short end of the bond market. And, they've been heavily incentivizing the banks to buy it, basically. And, because they took away the special leverage ratios for the banks, they basically took it to infinity so that the banks could buy it. And then if you look at the Fed, balance sheet, they've also been buying their own bonds. So the long story short, I mean, it's convoluted because of the monetary plumbing. And, they obviously don't want us to really fully understand what they're doing. But the bottom line is it is, in a macro sense, it really is as simple as Burr. They're printing money. They're creating more money to service their debt, and they're creating more debt to service that money. And I've talked about this in my letters in the past. The potential risk here is what that could lead to is a bond doom loop. I mean, and so the debt to the big picture, and we've talked about this before, Tom, is the big picture is we've got way too much debt to GDP. We just can't service it, and additional debt doesn't grow GDP. So the problem of additional debt only makes it worse. And in the past, this has happened in the past many times, lots of countries, and there are two or three ways to do it. I mean, you can default, you can restructure. Roosevelt did that in 1934, or you can inflate your way out. And defaulting is not a choice because obviously that's kind of country failure. That's what Argentina does, or Greece does. Restructuring, a la FDR. That's actually that would be my preferred route, and that would be a good choice. Admit we've got too much debt. Admit we've got to go to sound money. Create a new structure that the dollar is backed by silver and gold, and return to a sound money standard. I actually think that's the least painful, most fair way of getting out of this mess. But of course, it's not very well understood. I think the odds of politicians choosing are zero. And so what they're going to try to do is they're going to try and inflate their way out. And the problem with inflation is like being a little pregnant. You can't have a little inflation. In a system this broken, it's very likely a little inflation is going to turn into a lot of inflation. And so they did this after World War II because we ran up a lot of debt in World War II, and we have the same kind of ratio of the debt to GDP. And that was the first time the Fed used yield curve control, which is they held the bond market at a certain rate. They committed to buy whatever was necessary, and they let inflation run hot, knowing that they could do so. And they weren't really at risk of the dollar failing because the dollar was on a gold standard at the time. So this situation is slightly different, but the big picture is the same. They've got to have inflation. They've got to basically get the economy rolling and get prices going up so that the debt becomes serviceable. They've talked about it. They say we're willing to let inflation run hot. They consider this low inflation to be a problem. Of course, it has run hot and they're not reporting it right, but that's a different story. So
out of these inflationary, let's say, outcomes, Larry, you've said that you would rather see a hyperinflationary scenario play out. So why would that be?
Well, it's hyperinflation is going to. I don't know what outcome is going to happen, and hyperinflation is going to be very painful. But my point here, and what I believe, is that the system is really fundamentally deeply broken. At a political level and at a monetary level, and it, we're in a fourth turning, as a book that describes that situation very well. And we need to fix the system. And at the bottom of the breaking of the system, in my opinion, it's the money. The money's not sound, and that's why we have this problem. And it's built up over years and years and years. And now we've got the banquet of consequences. So we're going to suffer in any event. And I would suggest that, I've got a limited time frame on this planet. I'd say, okay, let's take a lot of suffering, restructure, go back to sound money, get it over with. And then, things will get better. I mean, I think once we go back to sound money, things will get much better. There is a better future on the other side of this. So, they could drag this out for 20 years and, we'll all be kind of quote unquote suffering. I mean, to me, this is no way to run a railroad. So I would much rather, and one could say this isn't correct, but I would much rather see it happen quickly, rip the Band-Aid off, so to speak, and solve the problem and get back on a sound footing so that we can have an economy that my kids and their kids, can live in and be proud of, and, everything kind of works the way it should. Because I don't think there are many people today watching watching what went on in DC and other things who could dispute the fact that, this isn't working correctly. I mean, this system is broken. It's very, very broken. And, putting Band-Aids on it, trying to fix it, this way and that way, I don't think they're going to work. And so,
and you were saying,
go the full measure,
And you were saying, as an example of Weimar Germany, once they kind of had that hyperinflationary bust, that things did, return. And start growing fairly.
Yeah, the people were so scarred they followed an idiot. They followed a psychopathic idiot. In Hitler. But yes, if you read the economic history of Germany, when they restructured, they came back and they originally tied the new mark, to land, and then they tied it to gold. And then some people tested them and they showed that they really meant it and that they weren't going to run the printing presses anymore. And yeah, Germany recovered pretty well. Mm-hmm. I mean, it was sad because a lot of people had their wealth wiped out. So to say it recovered well, it was pretty tough. But the fact of the matter is the economy got going again, and Germany became healthy again. And economically, and of course, then they, as I said, they went the wrong way politically, but that's a different story. Mm-hmm. It's, in my view, to avoid all of that pain and to make the pain be spread more fairly. That's why the structured, reval is a much better approach. I mean, what FDR did in 34, is a much better approach. And so, I would prefer we go that way. I think that's possibly why, Judy Shelton was being nominated for the Fed board, because she understands all this. And, she'd be a good addition. We are going to have a currency crisis here. I mean, we're having a currency crisis, really. Mm-hmm. I mean, that's in my view. And so we might as well think intelligently about how to get out of the currency crisis and make things better on a go-forward basis. I mean, interestingly, the bad news is, it's like yin and yang. The bad news is there's going to be a ton of pain. The good news is, that's going to lead to political reform. I mean, people are going to be damn angry, damn pissed off. And, who's going to believe the Federal Reserve? Who's going to believe our politicians? I mean, my guess is we're going to have a whole new set of people. We're going to have term limits. We're going to have sound money. And these are all better things. These will make a better world, but, in the interim, some of the powers that be who have a lot of money in bonds are going to get hurt badly. Mm-hmm. One of the things that we got cut off when we lost our internet connection earlier, and I talked about a little bit, but I think it's important to understand, is that the thing to watch here is the bond market. Mm-hmm. That's the next thing to go. I mean, when interest rates start going up because people in the bond market say, hey, I don't want to take these negative real returns. I mean, yeah, I hold a bond that's going to pay me back the principal, but what's that going to buy? There's obviously inflation here. And so the Federal Reserve has said, okay, well, we can't let the interest rates go up. The Volcker-like solution is no longer possible. So we're going to buy those bonds, and their balance sheet's going to swell, and that's going to people are going to realize that means printing money, and then inflation's going to get worse, and you can see what we're going. It's like an avalanche, or it's a doom loop, is what I call it. It just gets worse and worse and worse until the end point is the money's got no value, mm-hmm. and that's the model that I think a lot of people, a lot of investors, and others, not maybe people listening to your show in the sound money community, but I think most of the country is missing and does not understand that model and how it works. As I also say in my letter, we're getting to what I call, or said on Twitter, we're getting to what I call a tipping point. Mm-hmm. Where once enough people understand that this is an issue, then they start buying Bitcoin, gold, and silver, and gold stocks, and then it becomes self-fulfilling, right? And the bond market goes down, the Fed has to buy more, everyone goes, holy shit, the Fed, balance sheet's going up again. That means more inflation. I got to buy more gold, et cetera, et cetera. And pretty soon, it's a massive example of Gresham's law. And pretty soon, gold is worth $10,000 an ounce, and, the dollar just doesn't buy as much. So, gasoline will be $5 or $10, food will cost more, et cetera. So.
And just to kind of clarify that, the tipping point that you're speaking about is that when there's let's say 10% of people that start really buying into Bitcoin and gold, let's say, or sound money vehicles, then all of a sudden that's the tipping point comes when it enters
Right,
the more
right.
mainstream consciousness, right?
Right. Yeah. Malcolm Gladwell wrote the book on it, and there's been a lot of other studies about support his work. It basically say, if an idea is common and about 10% of the population gets it, and they're generally speaking correct, I mean, it's not a fraud, that the adoption then happens very rapidly.
Mm-hmm.
You spread from the early adopters to where it's completely obvious. I mean, I think our kids will say, "Oh my God, can you believe these idiots had the Federal Reserve setting interest rates, and they thought they could centrally manage, the money markets? I mean, they're like the Politburo setting grain prices. I mean, that's just what the hell were they thinking? They should have known that wasn't going to work. They got to have sound money. Mm-hmm. I mean, that's the way our kids will talk, and that's the way economics will be taught in universities in 20 years. And everyone will look back on this and say, I can't believe those people were so fucking stupid. I mean, really, how did they let their system get so screwed up mm-hmm. that they blew up the world money supply and had an enormous economic collapse based on hyperinflation? I mean, that's what I think will be
again.
Again. Well, in the German case, the good thing there, I mean, there were jokes about how in the nightclubs, I mean, when people were laughing hard, the comedians used to say, yeah, you must be long dollars or pounds, I mean, because, they had an alternative. If you were a German, you could buy gold, dollars, or pounds. I mean, the problem is, we've never seen, maybe except in Rome, we've never seen a hyperinflation in the world reserve currency. Never. Mm-hmm. And I think it's possible. I don't think it's guaranteed. I think it's possible. We might just have high inflation restructure, which would be good. I mean, that would do it too. I mean, to keep it simple, we need to return to sound money, because unsound money is what's gotten all the incentives wrong. It's why the middle class and the lower class have gotten totally screwed. It's why, the billionaires and the financial, money paper shufflers have made tons and tons of money and have been, just unfairly compensated for the value they add to society. And, it's risen to the point where there's a hell of a lot of socialist anger, and rightly so. Absolutely rightly so. It's terribly, terribly broken. It's terribly unfair. Mm-hmm. And there are those who are desperate about it. But what I would say to them is just relax. There is a God up there, and he's going to take care of it, because he's going to destroy the money, and we're going to go back to a sound system.
So Larry, as you're mentioning, return to sound money, and you mentioned earlier Judy Shelton, can you explain to our listeners that maybe aren't totally familiar with who she is and what her ideas are, what that could mean for the U.S.?
Yeah, so Judy's a wonderful woman. She's roughly my age, in her 60s, and she's been a monetary scholar for her whole life, written a lot of books, papers, got a PhD, and actually runs in the circles that the Federal Reserve people run in. But of course, they kind of look a little askance at her, because she's a gold advocate and a sound money advocate. She understands the gold standard, and it's funny, because she was brought up in front of the Congress and Senate for hearings, and I've never seen them treat somebody with more disrespect. I mean, it was appalling. I mean, this woman is a legitimate scholar with published articles, and even economists who disagree with her, admit that she's serious and knowledgeable about this subject, and they treated her with just incredible disdain. And the reason, of course, is they know that she's like silver to a vampire. I mean, she wants sound money, and man, oh man, does that mess up the whole political grifting game that these guys have going on. And, I think the only reason, and so based on those hearings, I thought, oh, there's no way this woman's going to get nominated. Just absolutely no way. And yet she did. And the only thing I can think of to explain this, I think the U.S. military is one of the few parts of our federal system that's not corrupted. And so I think they actually care about the good of the country and the good of the people. And so I'm suspecting somebody in the military who realizes that we've got a serious risk of a currency failure looked around, said, who do we have in this country that understands this shit really well? And Shelton, she's, and they said, guys, you want this lady on the Federal Reserve Board. You do, because she knows what the hell's going on. And if we have a currency crisis, you want her there to explain and to lay out what we need to do to get out of it. And so that's why I think they brought her forward. Now, unfortunately, she didn't make it, and it's been reserved. The possibility is that they'll bring her again, although with this vote in Georgia, maybe they won't, because the Senate's not controlled by the Republicans anymore. So, which it'd be sad if she didn't make it. But in any case, somebody's going to have to address this issue. And I think back to your tipping point thing that we talked about, I don't know. I mean, maybe I'm, just listening to my own bullshit, but I think a lot of people are understanding the sound money issue, and maybe it's a lot less than I think. I mean, I'm sure, it's interesting. I mean, I have, I interface with a lot of blue collar workers in a lot of different ways. I've got guys who, are electricians who, they just tell me, oh yeah, I get it. The currency's going to fail, and I buy silver every chance I get. So it's surprising to me that there are a lot of people who get it. Mm-hmm. I mean, there are a lot of people who understand how broken Washington is and how corrupt the system is and how printing money isn't solving any problems. It's just diluting the whole money stock, and they're buying, selling. So when we got to be getting close to that 10%. Mm-hmm. And once we get there, it can happen fast. So right. That's what I kind of think is happening right now.
Mm-hmm. So Larry, when you're looking at places to invest your money, or let's say currency right now, you talk about trying to find real asymmetrical bets. So can you share with us the numbers of how big the global financial markets are versus, let's say, gold and Bitcoin?
Yeah, I'd be happy to. And to me, that's one of the more compelling arguments for getting into these asset classes. And I want to talk a little bit about Bitcoin too, because it's in the news and it's an exciting thing. And I own a lot of it, and I believe in it very much. But I don't think it should be exclusively what you invest in. I know people are 100% Bitcoin. I'm kind of like, well, it's a lot of volatility to absorb. But let's go to the big picture. There's about $400 trillion of financial assets in the world. That's stock, and these are round numbers, but that's stocks, bonds, and cash. 400 trillion. Okay. In tradable gold, tradable gold and gold stocks is about 4 trillion, and add in Bitcoin is another 700 billion. Probably more this morning because it's breaking to new highs. But the point is, there's $4 or $5 billion of what we could call clear sound money bets, and there are people who argue that Bitcoin's not sound money, and we can go over that in a minute, but. Those clear sound money bets are gold, Bitcoin, and gold stocks. And so there's 4 or 5 billion of that. There's 400 trillion of other stuff, non-sound money bets, cash, bond, stock. As that tipping point gets reached and people start saying, I'm holding this cash, I'm holding these bonds, I'm holding these stocks. Are they going to be worth as much in the future? Some of them I think are going to start saying, no, they may not be. I'm going to start chasing some of that sound money stuff. And we don't need to have them all come over to our camp. I mean, and they won't, of course. But all it takes, you think about it at the margin, if only 10% of that 400 trillion says we need to go into the sound money area, that's going to be 40 trillion trying to buy 4. Mm-hmm. So guess what? The 4 is going to, the supply is relatively fixed. Gold grows a little bit. The 4 is going to have to go up a lot. And so those are the 3 buckets in my view. The safest, longest term bucket, I just want to touch on this, is gold, because it's been money for 6,000 years, and it's, the energy spent once and you hold it, and so on and so forth. No counterparty risk. Probably the fastest racehorse in the money debates, race, and Paul Tudor Jones, coined that term, is Bitcoin. I mean, it's crushing gold in terms of overall performance. The negative there is it's volatile as can be. Mm-hmm. And, I think some people are going to be buying it now, and if you're in it, you got to be prepared for wide swings. I mean, I was buying it at 19,000. It went down to 3,500. I bought more at 3,800. I mean, and I never thought about selling what I bought at 19,000. But, the average investor who goes and chases Bitcoin right now, might be disappointed on the next drawdown if and when it comes, right? And my guess is it'll come because there've been 6 of them so far. So, mm-hmm. So you got that. And then in the middle, there's the gold stocks, which are, companies that have the ability to pull gold out of the ground and generate a cash flow stream. And what I find most amazing now as I'm managing a gold stock fund is just how cheap they are. I mean, I have things they're selling between 3 and 7 times cash flow, which is a very low multiple compared to the overall stock market. And that's at a $1,900 gold price. And, if gold goes up a lot, I think it will, that cash flow number is going to go up a lot. And then that multiple can expand. And so you kind of combine those two. That's asymmetry. Mm-hmm. I mean, you can lose 1x what you put up. I mean, I think everything in my portfolio could go up between 3 and 9x. Mm-hmm. And so, even if it's only 3, that's probably better than, what the gold price. I mean, the 3 would be if the gold price stays flat, and the 9 would be maybe at higher gold prices. So, there's asymmetry out there to be had. And I would never suggest anybody put all of their money necessarily in these categories. I mean, I have, but, that's what I do because I'm a professional in this area. But the argument I would make is that everybody should have some in this category. I mean, I've mm-hmm. got friends and neighbors who have laddered bond portfolios. They're my age, they're retired. And I'm kind of like, they got big portfolios that are full of things like Tesla. And I'm kind of like, geez, guys, don't you think you want to have some stuff that, will do well if all that other stuff stops doing well.
Mhm.
And, a lot of them are kind of pretty blasé about it. Like, no, you're a crazy gold bug. And, I'm not going to listen to you. so I'm like, all right,
Larry,
whatever.
do you think at some point that if all that money starts coming into these sectors, it could create a bubble-like situation in both of them?
Yeah, it could. I mean, it could. I was an internet investor. A guy gave me a business card in '93 with internet apps. And I said, "What's that?" I was a venture capitalist. And I went, I was blown away, and I went and I started buying private internet companies in '94, and that worked out really well.
Mm-hmm.
And that became a bubble. And in 2000, I was getting out of the internet. And yeah, it could become bubbly here. No question. I think we're a long ways away from that. I mean, in baseball terms, people said, "Where are we?" I mean, I think we're somewhere between the second and the third inning. So, that's a ways down the road in my estimation, but yeah, definitely because, humans don't change and people chase trends and they chase performance. And I often think to myself, boy, what happens when the Robinhood crowd gets on board with gold related stuff and sees how well it's doing? I mean, to an extent, the Robinhood crowd is what's driving the cryptos, right? I mean, Bitcoin is young person's gold, right? I mean, it's a technology. It's a play on fiat, money going to zero, but it's also a play on a technology, that makes moving large sums around easier, and doesn't involve storage costs and so forth. So yeah, it's I don't know. Did that answer your question?
Yeah. So Larry, could we see the S&P and tax revenues fall in tandem? Why would this be, and how are they linked?
Well, very much so. I mean, I think Luke Roman points this out a lot, that, I think the S&P is almost a policy tool of the United States government. I mean, they need to have the government going up, or else this economy, that's what I don't think people understand, is just how many steroids have been injected into this economy. Mm-hmm. And if they don't continue injecting steroids, this economy is going to fall over and die. I mean, if the S&P were to go down 50% right now, and think of the reverse wealth effect of poor people, oh my God, it would be a horror show. And so they need to keep, in my report that's coming out, they need to keep the stock market going up. They absolutely have to, or else the deflationary forces will overwhelm things. And so, I think there's a greater chance that we have a Venezuelan or a Weimar-like, and I show these charts on my quarterly, melt up in stocks. And look, stocks are better than bonds. I mean, even in Weimar, if you'd owned, Daimler-Benz or not Daimler-Benz because it was small, but if you'd owned Siemens as an example, big industrial company in Germany, you'd have made it through, right? I mean, because a stock is an ownership, a share in a business that, when the currency gets repriced, the shares will still have value in the new currency. Mm-hmm. So, I mean, they may have, in the middle of the melt up, they may have lagged or been behind, but if you held your shares, you owned a share of a business. And so in that respect, stocks are not the worst thing to own in hyperinflation. Bonds and cash are. But, obviously, in my opinion, the gold stocks will be much better than just the average stocks. Mm-hmm. And, I think that there are clearly some stocks that have bubble-like characteristics today out in the marketplace. I mean, it's stunning to me how this free money has driven the overall stock pricing.
Mm-hmm. So, Larry, as you're talking about the gold stocks there, can you share with us some of your criteria on how you evaluate these companies to invest in?
I mean, so first of all, this is a very tough industry. It's a very shitty business. I mean, it's breaking rocks, and you got all kinds of risks. I mean, there are more Murphy's Laws items in this area than you can imagine. And in general, I wouldn't be interested in it unless you had an enormous macro tailwind, which I think we do here. Mm-hmm. So I think, the macro tailwind is going to make up for a lot of sins. Having said that, the lowest risk category within the thing, and I've said this in many interviews on the web, but I'll repeat it because it's important, is to find what I call emerging producers. And so these are, there are three buckets, right? There are companies that are producing cash flow. There are companies that are trying to develop a mine to produce cash flow. And there are companies that are drilling good rocks to show that they've got a big deposit. So, producers, developers, drill stories. The producers, emerging producers, are the sweet spot, the best reward for your risk. So you find a company that's producing gold, and that you get a couple of benefits. One, their production might grow, and two, they've got operating leverage from higher gold prices, and three, they often sell at low multiples. Barrick and Newmont sell at 10, 11, 12 times cash flow. I've got a lot of companies in my portfolio that are selling between 2 and 6x cash flow. Mm-hmm. That's because they're small, they're not well known, et cetera. As they grow and become better known, become more powerful, those multiples will expand. So, gold stocks go up for three reasons. They go up because the price of gold goes up. They go up because their production increases, therefore their cash flow increases. Or they go up because the multiple people are willing to pay for them goes up, multiple expansion. Mm-hmm. And so if you can find a small growing gold stock with increasing production, selling at a low multiple, that's your greatest chance for multiplying your money. Having said that, they all have risks. And so I would never advise anybody to be in any less than, 10 or 15 of these things. You want to find a bucket of them that all look similar, knowing that out of that 10 or 15, 2 or 3 of them will fail. 2 or 3 of them will give you average returns or low returns. And then a couple of them will really hit it hard and become, 5, 10, 15 baggers. And if you take all that money and blend it together, you can have a good rate of return. Mm-hmm. So that's the lowest risk area. In parts of the cycle, being in the drill stories is the quickest, easiest money, but there's a lot of risk associated with it. And you got to really understand the geology and know how to pick them. Mm-hmm. But you can multiply money very quickly in drill stories as well. You can also strike out. So and in that area, I wouldn't advise it for people who don't really understand the business and don't have a geological context or people helping them to understand drill stories. So.
Mm-hmm. Larry, do you think that a lot of those, let's say, high points in those stocks are going to come at relatively the same time if we see a very high gold price, or is there going to be a different way to really have to let's say evaluate each one of these holdings as they go? You're
going to have to kind of evaluate, move around. I mean, I'm pretty heavily into some drill stories right now because I think we're in the second inning and I think we've got a lot of room in front of us, and they're still quite cheap relative to the resources they have. Mm-hmm. So I think that's very good. In 3, 4, 5 years into the cycle, I probably won't be into the drill stories as much because one, they won't be as cheap, and two, the market will be moving towards cash flow, in my opinion. And mm-hmm. So, I think the producers and developers will become a better place to be as we get further on. I mean, all of these, in all these situations, Tom, you're really trading off upside, downside. I mean, and asymmetry, as you pointed out earlier, asymmetry is what you're going for, right? Mm-hmm. Trust me, in every gold stock, you can lose all your money. These are not SaaS software businesses where if things go bad, you're going to go sideways and get sold to somebody else. Mm-hmm. If you're wrong, you're going to get wiped out. So and people need to understand that. I mean, it looked like easy money, but it's not. However, if you're right, if you've done your analysis and you're right, and I don't go into anything where I don't think it's going to double at least. Mm-hmm. And I've got things that could be 4 to 10x. And, it depends on a lot of things. It depends on getting the new plant going. It depends on developing the new mine. It depends on the gold price, politics, et cetera. But the point is, if they work, and it depends on multiple expansion, if they work, I mean, when they work, it's a very powerful thing. I mean, go look at the chart of Kirkland Lake, go look at the chart of Wesdome. I mean, I was in both of them. I'm not in either one of them now. They're too pricey for me. Mm-hmm. They're good companies. I mean, people who buy them will do fine. They will trade with or above the market because they both have excellent management teams. But the point is that, if you're looking for alpha in the space, you want to find those emerging producers, before everyone else finds them, when they're still cheap enough to have real multiple expansion. Mm-hmm. And then also you want to get your macro timing right. And by the way, I think we got our macro timing right. I mean, here's another statistic that I think is really important to blow people away. Typically speaking, a gold stock is a flow of funds out of a company that produces gold, right? Mm-hmm. So, just economic theory, you own a lump of gold, it doesn't change. It goes up or down based on its relationship to the dollar. You own a gold stock, it has a stream of cash flows in theory going forward, depending on the price, that you can discount back. So what am I getting at? Well, if gold goes up 10%, a gold stock ought to go up 30%. Gold stocks ought to go up 30%. It's just kind of a rule of thumb. Why? One is a fixed amount, it's like cash, and the other one is an operating company that's throwing off cash. And so, a 10% move in the cash ought to generate about a 30% move in the stock, maybe more, but 30 seems to be the average over a lot of cycles. This past year, gold went up 25%. GDX, the big gold stock index, went up 23%. So what that informs me is that people still don't believe in gold stocks. I mean, they're still looking at this. I call it battered gold bull syndrome. They're still looking at this and saying, well, this is a shitty business. And these managers fucked it up last time. So I don't want to play. And so what should have happened is gold, the GDX should have been up 75% this year, but it wasn't. And so it's still, as much as people look at my results, they say, well, Jesus, we had a couple good years. Have I missed it? Like, no, you haven't missed it. I mean, now 3 years from now, it's not going to be as easy. We're not going to be buying things at 4 times cash flow. And, it's not going to be, just almost by definition, as the prices get higher, the risk reward gets worse for a new buyer. But, but we'll deal with that 3 years from now. I expect my portfolio to be a couple turns from then, from where it is today at that point in time. And maybe there might even come a time to exit this. There'll be, there might be sound money alternatives coming. Gold might not be the place to be if it looks like we're going to get a system that's, restructured. But, you deal with all those as you go along. I can say with high confidence right now that for people making placements in this area, I think your timing is good and you're going to do well. You obviously wouldn't have done as well if you did it, and I had some people, of course, join my fund in August, and they're just back to break even. But, from August until now, there was a correction, right? It came in substantially. And so, and I was selling some things in August and it's human nature, right? It's when it gets totally to a boil, eventually at some point, it'll find a point where there are no more buyers and it's going to correct. This will happen with Bitcoin. I don't know where. I don't know if it's at 38 or 75 or 100, or if you believe Max Kaiser, it's at 220. I don't think this run goes that high, but I'm still buying at this level, on a kind of a consistent basis. A lot of my investments, I like the dollar cost average. So, and I do believe longer term Bitcoin is going to work. So
yeah,
there are risks, but I think we'll overcome them.
Larry, as we wrap up here, something that came to mind as we were talking about the gold stocks, are there any particular jurisdictions that you favor right now? Yeah,
so a lot of people worry about jurisdictions. arguably, with a Democratic president, the U.S. could become a crummy jurisdiction. Nevada used to be one of the best ones. And Doug Casey makes the point, I'm not sure if it's Doug Casey, no, it's Rick Rule makes the point that every jurisdiction is risky, and he's right. There are certain ones I definitely don't like. Like I don't like Ecuador. I will not make an investment in Ecuador. And there are others that are problematic. I think honestly, it's always a risk and always a problem. Countries always want to, when they see a pot of money, they always want to go after it. Fortunately, the gold companies have been pretty good at educating these countries that, it's a golden goose. If they want to come after it, they're going to kill the whole thing. And they're better off to take their royalties and their slice of the profits and leave them alone versus, coming after it. And most of these countries that do come after it, they don't know how to run these mines. So, and that's been demonstrated over and over again. So, the way I deal with jurisdictional risk is there are a few jurisdictions I won't touch. But, in general, diversity is the way I deal with it. I probably don't have anything that's more than 3, 4, 5% of my portfolio. And I probably don't have any country or jurisdiction that's more than 10%. So if something really goes the wrong way, that I'm not going to get wiped out. But again, I'm talking about an asset class that is risky. And so diversity is the best way to deal with risk. You want to have a lot of different names in different areas so that if something goes the wrong way, it's not going to wipe you out.
Perfect. All right, Larry. Well, you were mentioning earlier your letter that's going to be coming out.
Yeah, it'll be coming out soon. And so I'd like to make a request, actually. Please don't email me asking me to put you on the list. I'll tell you why. I'm getting like 30 emails a day. I just don't have time to enter all the emails onto my list. I'm going to kind of on a recurring basis. So go find me on Twitter. Okay. So I'm at Lawrence Lepard, just my name, no middle initial, at Lawrence Lepard on Twitter. Go find me on Twitter and then check my Twitter feed. And every couple of days on my Twitter feed, I will put up a link to how to subscribe to the newsletter. And so you can self-subscribe to the newsletter. And if you want back issues, email me for that. But you'll get, if you self-subscribe to the newsletter, and I also post the newsletter on Twitter too, a link to it. It's on a Google, it's Google server or whatever, Google
Doc,
Google Docs. Yeah. And so go there, go to Twitter, sign up, and the Q4 report should be out end of this week, early next week. And it repeats a lot of what we talked about here today, but it does have some other interesting charts and so forth that show, that argue in favor of what I think is pretty well baked in the cake. It's hard to know the time frames. And we get big pullbacks. Like yesterday was pretty rough, but this is the nature of the game. I mean, again, asymmetry, asymmetry comes with volatility, right?
Mhm.
Bitcoin's probably the most asymmetric, exciting upside, investment in the world today. But, don't skip the volatility piece because it is there. And
Absolutely.
people need to be aware of it. So
You're all